All right, ready to dive deep into options and volatility trading.
Oh, absolutely.
We've got excerpts from Trading Volatility, Correlation, Term Structure, and Skew by Colin Bennett.
A classic.
So let's unpack this together, see what we can learn. But first, the basics. Can you explain call and put options, like jargon-free?
Okay, so imagine options like contracts that give you the right, but not the obligation, to buy or sell, say, a stock.
At a specific price?
Right, by a certain date. That's your underlying asset.
Okay.
Now,
Understood.
call option you can buy. Put option you can sell.
Makes sense, but why use an option? Why not just buy or sell the stock directly?
Leverage. With options, you control a bigger position, but with a smaller investment,
I see.
like a small down payment for something much bigger.
So I think a stock's going up, I buy a call option, potentially bigger profits.
Exactly, and that's where volatility comes in. You're betting on how much the price will move, not just the direction.
So a stock jumps around a lot,
More volatile it is,
the more valuable the option.
precisely. It's all about uncertainty. Bigger swings, higher chance of, going either way.
Gotcha. Now what about time value? I hear that a lot with options.
Think of it like a concert ticket. Closer to the date, more valuable it gets, even if the band's still the same.
I see.
It's how much the option price is above its intrinsic value, meaning what you'd profit if you used it right now.
Longer until it expires.
More time value.
Or time value. And this is highest for at-the-money options, right?
That's right.
Remind me what at-the-money means again.
So the strike price, that price you can buy or sell at, it's close to the asset's current price.
So stock's at $100, and at-the-money call option would also be at $100.
You got it. And because it could end up in the money, meaning profitable,
Right.
but also might expire worthless, there's a lot of uncertainty. That's reflected in the higher time value.
Time value. It's like, the options potential, right? More time, more chance the price moves your way.
Exactly. More time for your bet to work out.
Okay, basics down. But how do you actually trade these things?
Lots to consider. Strike prices, expiry dates.
Right, all that.
First, understand delta.
Delta,
It measures how much an option's price changes for every dollar the asset moves.
like a sensitivity measure.
Exactly. Let's say a call option has a 0.5 delta. Every dollar the stock goes up, the option goes up 50 cents.
Makes sense.
But, and this is important, delta isn't the same as the probability of, the option being profitable ending in the money.
But if the delta's high, isn't it more likely to be in the money?
Well, not that simple. Call options, theoretically, unlimited profit if the stock keeps rising.
Okay.
Puts, their max value is capped by the strike price.
Right, because a stock can't go below zero.
Exactly. So that asymmetry affects the delta calculation. Delta's a good indicator, but not the whole story.
So much nuance.
Yeah.
Okay, now what about choosing those expiry dates? Farther out seems like more time for things to move in your favor.
Not just about time. Picking a date forces discipline, avoids what we call portfolio inertia.
Portfolio inertia.
Basically getting stuck. An expiry date makes you decide, how long do I hold this? Reevaluate as that date nears. Close it, roll it over, forces action.
I see. Keeps you on your toes, makes you really think it through.
Exactly. Ready for something even wilder? Let's talk about how volatility itself became a tradable asset.
Volatility as an asset. Now that's something I need explained.
Think back to the 90s, hedge funds rising. Suddenly, everyone wanted to bet on or hedge against volatility directly.
Okay, I'm intrigued, but before we go there, let's clarify. Volatility versus variance, they're not the same.
You're right, they're related, but different. Volatility is how much the price fluctuates, like the size of the swings.
Up and down, up and down.
Variance is volatility, but squared. A bit more technical, good for certain calculations.
But why use variance in trading if they're both measuring the same thing?
Think of a strategy profiting from volatility. Double the volatility, your potential profit doesn't just double, it quadruples. Variance makes these calculations simpler, easier to compare opportunities.
So variance packs more punch when it comes to seeing those potential ups and downs.
You got it. Now let's get into the mechanics of trading volatility itself. Two big concepts, delta hedging and gamma scalping.
Okay, break those down. What's delta hedging?
Remember delta? How much the option price changes with the underlying asset. Delta hedging, it's managing your risk. You're neutralizing that delta.
Neutralizing.
So you buy a call option, right? It has a certain delta.
Right.
To hedge, you sell some of the underlying stock. The amount is based on the option's delta. So Gains in one offset losses in the other, vice versa.
You're balancing things out, minimizing the impact of those price swings.
Exactly. Staying delta neutral isolates your exposure to changes in volatility itself, like removing the stock's direction and just focusing on how much it jumps around.
Not betting on up or down, but on how wild it gets.
You got it. Now, gamma scalping, that takes delta hedging a step further. You're constantly adjusting the hedge, trying to profit from every little market move.
Instead of just setting it and forgetting it, you're always tweaking, always reacting.
Yep. Remember, gamma is the rate of change of delta. Positive gamma, meaning you've bought options, you benefit from movement in either direction. Gamma scalping tries to grab those profits by adjusting the delta hedge as the market moves.
This is getting intense.
It can be,
Huh.
but lots of experienced volatility traders love it. And here's the crazy part. All that hedging, it can actually move the price of the asset itself.
Wait, really? How?
Imagine tons of traders all delta hedging the same option. All that buying and selling. It creates pressure on the stock price, especially if it's not very liquid or the option position is huge.
So volatility traders, their actions ripple out into the market.
It's wild, right? Shows how intertwined options volatility in the stock market are, ready to go even deeper.
Lead the way. All right, so options check. Volatility as its own trade, check. Delta hedging, gamma scalping, all those trader tricks. I'm keeping up, I think.
We've only just begun. This world's got layers, especially for the pros who live and breathe volatility. For example, some fund managers, they use options to, supercharge their stock portfolio returns.
Supercharge returns. Now that's something I want to hear about.
One move they make is called call overwriting. Imagine a fund manager owns a ton of some stock, bullish long-term, but thinks short-term it might just go sideways, maybe dip a bit.
They're expecting volatility, but not necessarily a big price jump.
Exactly. So they might sell call options against that stock position.
Wait, sell? Wouldn't that limit their gains if the price actually shoots up?
It would, but there's a trade-off. By selling, they're giving someone else the right to buy that stock at a certain price. If the stock stays below that, the option's worthless. They keep the premium, the money they got for selling it, extra income on top of their existing stock.
So they're giving up some potential for guaranteed income right now?
You got it. A way to profit when the market's not super hot, but not crashing either.
A Goldilocks market.
You could say that. And fun fact, there's an index tracking this exact strategy on the S&P 500, the BXM index, longest call overriding data we've got.
So you can see how this strategy actually performs over time.
You can, but important note, BXM includes the income from those sold options. You got to compare it to a benchmark that also has dividends, the S&P 500 total return, not just the price return.
Apples to apples. Makes sense. Now, what about when you're not feeling bullish? You're actually worried about a crash. Can options help protect your portfolio?
Oh, absolutely. Options are great for that. Simplest way, buy put options on an index, like the S&P 500, or a specific stock you're nervous about.
So you're buying the right to sell even if everything tanks, like portfolio insurance.
Exactly. But insurance has a premium, right? Puts can be pricey, especially if implied volatility is high. Remember, high volatility, more expensive the options get.
So if you can't afford that high premium, how do you make protection cheaper?
Good question. One strategy is called a put spread collar. Sounds fancy, but it's not that bad. Instead of just buying a put, you buy one with a lower strike price and you sell another with a higher strike. You're setting a range where you're protected from losses.
Okay, so below that lower price, you're good. But what about gains? Don't you lose some by selling that other put?
You do. That's the trade-off. Less upside, but cheaper protection. Balancing act, depends on how much risk you can stomach, what your budget is.
So with a put spread collar, you're saying, I'll take a small loss, but I still want some of those gains if things go well.
Right. One more thing. This kind of protection strategy, it's usually at the index level, not for individual stocks.
Why is that? Wouldn't it be better to protect the specific stock you're worried about?
You'd think so, but investors, they're mostly hedging against broad market risk, not one company failing. If the whole market crashes, your stock's probably going down too, even if it's a good one.
That's true. So worried about a single stock, maybe just sell it instead of getting fancy with options.
Exactly. Another thing, when you're doing this protection, you got to decide on the option's maturity. How long do you think this market downturn might last?
So short-term options, they're pricier, but better if things crash suddenly.
Exactly.
Yeah.
Longer-term ones are cheaper, but might not help as much if the drop is super fast. It's always a trade-off.
Finding that sweet spot between protection and how much you're willing to pay.
You got it. Now, Ready for some exotic options?
Exotic options. Now you're talking. What are those?
These are like the custom-built sports cars of options. They do more complex payouts than your basic calls and puts. One example, a worst of option.
Worst stuff.
Say you've got a bunch of stocks, 5, 10 companies. This option pays out based on the one that does the worst.
Yeah.
You're betting at least one of them's going to tank.
Betting on the weakest link, not any specific company.
Exactly. And correlation matters here. Investors, they tend to buy correlation, which makes things that don't correlate more attractive for these options.
So stocks that zig when others zag, higher chance one of them will crash.
That's the idea. Now, another one's called a look-back option. You could look back over some time, like a year, pick the best price the asset had.
So like if it's a call, you lock in the highest price even if it's gone down since then.
Exactly. Put option, you lock in the lowest. These are often multi-year, market has time to move around, gives you a good chance to find a favorable price.
Sounds powerful, but probably expensive too.
They can be, especially the ones where you get to pick the best historical price. But there are others where the strike moves against you. Those are cheaper.
So all sorts of exotic options, different payouts, different prices, matching different goals, and how much risk you like.
You got it. Now, for investors dealing with different currencies, there are composite options.
Composite.
Imagine you're in the U.S. You want to buy a call on a European stock, priced in euros. Composite option lets you do that, but the payout's still in dollars.
So the option price is affected by both the stock and the euro-dollar exchange rate.
Exactly. And correlations back. These are long correlations.
Yeah.
They do well if the stock and the euro both rise.
Stock goes up, euro gets stronger, you win twice.
You got it. Now, there's something similar called a quanto option, but it's got a twist. It takes out the exchange rate from the payout.
So even if the euro weakens, you still get paid based on how the stock did in euros.
Exactly. Quanto options, they're often for hedging currency risk. Like if you're in the U.S., own a European stock, you might buy a quanto put to protect yourself if euro tanks.
So you're separating the stock risk from the currency risk. Clever.
It is. And quantos can be long or short correlation. Depends how they're set up. Very flexible.
This is getting pretty advanced. Now, what about this relative value trading I hear about? Where does that fit in?
Ah, good one. Relative value, it's a whole category of strategies. You're finding pricing differences between assets that are related somehow. You spot something mispriced and you bet that difference will eventually go away.
So like two stocks in the same industry, they usually trade at similar values, but one's suddenly cheap compared to the other.
Exactly. You buy the cheap one, short the expensive one, wait for the prices to even out.
Makes sense. How does this work with options and volatility, though?
Same principles, but in the options market. Maybe you find two options on the same stock, different strikes or expiries, but their implied volatilities don't line up. Or maybe the index's implied volatility is way off compared to the individual stocks in it.
You're looking for the market mispricing how volatile something is compared to something else.
Exactly. You can use options to build trades that profit when that mispricing gets fixed.
Amazing. This world is huge. But how do you actually do relative value with options? Just buy and sell them directly.
You can, but you can get fancier, use combos of options for specific payouts. Instead of trading the actual stocks in a pairs trade, you could buy calls on the cheap one, sell calls on the expensive one.
You're doing a pairs trade, but with options instead of the stocks themselves.
Right. You can tweak the risk and reward by changing the strike prices, the maturities. Now, big thing in relative value is weighting. How much of each side of the trade do you take?
That's a good question. Depends on the trade, I guess. Are there any rules of thumb?
One common way is to weight by the beta of the assets. Beta measures how sensitive the price is to the overall market.
So beta of 1, it moves with the market. Beta of 2, it swings twice as much.
Exactly. Weighting by beta, you're trying to make the position market neutral.
Meaning?
The whole trade's performance shouldn't be affected much by the market going up or down. You're isolating just the difference between those two assets.
Taking out the market noise, focusing purely on that price gap.
You got it. Another factor, carry.
Carry.
It's the income or cost from holding a position. Short a stock, you might pay borrowing costs. Long a bond, you get interest.
Ongoing cost or benefit. Got it.
In relative value, carry matters, big time, especially with volatility.
Why is that?
The carry in a volatility trade, it's like the difference between the actual volatility and the implied volatility. Shorting volatility, you're hoping the real thing is lower than what's implied. You profit from that.
You're getting paid for selling volatility that doesn't happen.
Exactly. And the longer you hold, the more that carry matters to your profit or loss.
So the time horizon becomes super important when you're thinking about carry.
Absolutely. One last point. With relative value, it's not the level of volatility that matters. It's the difference between the volatilities of the two things you're trading.
So even if both are volatile, there's still a trade if one is way more volatile than the other.
That's right. It's all about finding those pricing mismatches.
This has been a whirlwind. I see the potential, but this is complex stuff, always changing too.
It is. But the more you understand volatility, the better you can navigate these markets. And we're not done yet. Still more to cover.
Wow, we've covered so much ground. From basic options to these exotic ones, and even how the pros use them. Feels like I've got a whole new lens on the markets now.
It's been a journey. But remember, this isn't just theory, right? We want to use this stuff in real-world trading.
Exactly. So as we wrap up, what does all this mean for someone actually wanting to trade volatility? What are the big takeaways here?
Well, one huge thing. Implied volatility. It's not just some number on a screen. It's like the market's mood, what everyone's expecting.
So it can tell us how the market's feeling right now.
Exactly. High implied volatility. It's like the market saying, buckle up, things are going to get wild. Traders are expecting big moves. Maybe earnings announcements are coming up, economic data, something like that.
And low implied volatility means things are calm, predictable.
You got it. But here's the thing. Implied volatility, it's not always perfectly rational.
Right. We talked about investor sentiment, even how much demand there is for those structured products that can mess with implied volatility. It's not always a perfect picture of the real market.
Exactly. Remember, those structured products that protect you from losses, those can push up the implied volatility of puts. Even if the fundamentals don't really support that high volatility, just the demand alone can bump up those option prices.
So it's like the demand creates the volatility it's trying to protect against.
Exactly. That's
Yeah.
why you got to look deeper, see the story behind the numbers, not just follow them blindly.
Be a detective, not just a math whiz.
Right. Another takeaway. There are tons of ways to trade volatility. What works for you depends on your risk appetite, your goal, how you see the market.
It's not just plugging numbers into a formula.
Not at all. You need market knowledge, a good eye for opportunities, and gotta manage risk like a pro.
Sounds challenging, but exciting.
It is. But any trading has risk. You can lose money, especially if you're not careful. So have a plan, know your tools, and never risk more than you can afford to lose.
Solid advice. Now, any final thoughts for our listener? Something to think about as they keep learning about volatility.
Yes. We talked about how events and investor behavior can affect implied volatility. So here's something to ponder. What's happening right now that might be creating those temporary mispricings in volatility, those opportunities to trade?
Give us an example.
Well, think about big companies announcing earnings soon,
Yeah.
or some geopolitical thing causing uncertainty, or even just a change in how investors are feeling, driving up demand for certain options.
So pay attention to the news, the economic calendar, the overall market mood.
You got it.
Yeah.
Those things can create ripples in volatility, and if you can ride those ripples, you might just catch some profits.
Like surfing, but we're surfing on volatility.
Perfect analogy. And remember, learning about volatility never really ends. The market's always changing, throwing new curveballs and opening up new doors. Stay curious, keep learning, and embrace the challenge.
This has been eye-opening. Thank you for guiding us through all this.
My pleasure. Remember, knowledge is power, especially in finance. Keep exploring, keep learning, and keep diving deep.